I have to just start today by talking about the elephant in the room, the pain. The financial pain every homeowner in Colorado is feeling.
Mm.
I just got my renewal. My rate jumped 40%. And my first gut reaction, is to just throw my hands up and say, okay, that's it. I'm going online. I'm going to find something cheaper and save a few $100.
And that frustration is 100% valid.
Yeah.
You are not alone in feeling that, I promise you.
It's just insane.
It is. And it's important to understand this isn't just a normal price hike. We're in what's called a hard market. And it's hitting Colorado especially hard. We're actually projected to be one of the 4 most expensive states for home insurance in 2025.
Wow.
The average policy is already pushing, what, $6,600?
So we're all paying more. But what is a hard market in real terms? Is it just sticker shock?
No, it's more systemic than that. A hard market means insurers are writing fewer policies.
Yeah.
They're raising prices, obviously. But, and this is the important part, they're also tightening their coverage terms. The contracts are getting much more restrictive.
Okay.
But here's the pivot you have to make, especially if you own a home over $1 million. The 40% rate hike isn't the main danger.
It's not.
No. The real danger is paying 40% more for a policy that, well, that still leaves you massively exposed to a 6-figure loss.
Okay, so that really clarifies our mission for this deep dive then. We're talking specifically to homeowners with properties over $1 million. And the goal is to find those hidden coverage gaps that these, standard policies leave wide open.
Exactly. Especially in this new environment. Because the foundational truth for every single Colorado homeowner now is that the Marshall Fire changed everything. The old rules, the kind of rules that most mass market online policies are still built on. They just don't apply anymore. If you haven't really dug into your policy in the last 2 years, I can almost guarantee you are vulnerable.
So let's establish that. Why is Colorado this insurance crisis zone? And we know about the Marshall Fire, but what are the other forces at play here?
It's really a perfect storm. It's a convergence of factors. So first, you have the rising frequency and severity of natural catastrophes all over the world. Global claims in 2022 hit, I think, $270 billion.
Whoa.
Yeah.
Yeah.
Way over the average. And that loss has to be recovered, so it trickles down to all of us in our premiums.
And then you've got inflation on top of that.
Precisely. Inflation is compounding these losses in a way we just haven't seen in decades. When you rebuild a home, roughly 60% of the cost is materials, 40% is labor. Both of those are. They're just so much higher than they were pre-2020. Insurers are basically playing catch-up.
And I guess the final piece is that the insurance for the insurance companies is also going up.
That's the third factor. It's called reinsurance.
Okay.
And because global risk is higher, the cost for carriers to offload their own risk is skyrocketing. And guess who that cost gets passed directly onto?
The policyholder, us.
The policyholder.
Okay, so this brings me to a huge misconception I hear all the time. People look at their home on Zillow, they see it's worth, say, $1.5 million, and they just insure it for that amount. Why wouldn't I do that?
That is the single most common and honestly the most dangerous mistake we see. It leads directly to catastrophic underinsurance.
Really?
You have to remember, you're insuring the structure, the sticks and bricks, not the land it sits on or the great view or the school district. Your dwelling coverage has to be based on reconstruction cost, RCV, the cost to rebuild it from the ground up.
So even if my mortgage is paid off and the market value is high, my reconstruction cost could be totally different.
It could be higher. For custom high-end homes in Colorado, with unique finishes, complex architecture, the RCV often needs to be 20 or even 30% above the market value just to replicate the quality of what you lost.
And we saw how badly this can go wrong after the Marshall Fire.
It was heartbreaking. I mean, nationally, something like 2/3 of homes are underinsured. But in the Marshall Fire, 74% of policyholders were underinsured. And get this, 36% were severely underinsured.
What does that mean, severely?
It means they had less than 75% of the actual cost to rebuild. Imagine losing everything and then finding out your insurance check is $300,000 short. That's the financial gap we're trying to prevent.
That really puts it in perspective. Okay, let's get into the 2 most dangerous hidden gaps that people fall into. I'll be the skeptical homeowner again. I found a quote online. It saves me $800 a year. The price is right. Why shouldn't I take it?
I don't compete on price. I compete on value-y, on making sure you're actually protected. Before you sign that policy, tell me one thing. What is the hail deductible?
I assume it's my normal deductible, $1,000, maybe $2,500.
And that assumption is the trap. It's how they get the premium to look so good. Colorado is ground zero for hail. It's not a secret. Hail events are up 65% in the last 3 years. The majority of our premiums are paying for that risk.
So what are the insurers doing?
They're quietly switching from a flat dollar deductible to a percentage deductible.
Okay, explain what that means in the real world.
It means your deductible is no longer a flat $2,500. It's calculated as 1% or sometimes even 2% of your dwelling limit,
The total value of the house.
the total insured value. So let's use your example, a $1.5 million home. You check that little box for the 1% wind hail deductible to save $800 on the premium. You've just signed up for a $15,000 out-of-pocket expense before your insurance pays 1 penny for a new roof.
$15,000. And the online tools, they don't exactly scream that at you. It just says 1% deductible.
They bury it. The average person doesn't translate 1% of dwelling limit into 15 grand out of my savings. They just see the lower premium. That's the real exposure people are buying into without realizing it.
That is a huge, huge difference. Okay, what's the second big hazard, especially for people with older, custom homes in places like Boulder or Cherry Hills? You called it the code upgrade trap.
We call it the ordinance or law coverage gap. And it is, without a doubt, the single greatest hidden bankruptcy risk for these homeowners.
Bankruptcy risk, that's a strong term.
It is, because a standard policy is designed to rebuild your home as it was. But building codes in Colorado have changed. If a fire or another disaster damages more than, say, 50% of your home, the local government can force you to rebuild the entire thing to today's much stricter codes.
So my older home, with its older wiring and plumbing, if it has a major fire, I am legally on the hook for all new electrical, fire-resistant materials, new HVAC, all of it.
All of it. And this is where standard policies are just criminally inadequate. They might give you 10% of your dwelling limit for this.
Yeah.
So on a $2 million home, that's $200,000 in ordinance or law coverage.
200 grand sounds like a lot of money. Is it not enough?
It sounds like a lot until you see what it has to pay for. First, the loss to the part of the house that wasn't damaged but now has to be torn down. Second, the demolition cost itself, which is massive. And third, the increased cost of construction to meet all those new codes.
So that $200,000 just disappears.
It evaporates. For a complex custom home, we often recommend limits closer to 25% or even 50% of the dwelling limit to really close that gap.
So if these standard policies are so full of holes for homes over $1 million, why should I pay even more for a specialized high net worth carrier? Is that just a luxury, like a fancy label?
It's not a perk. It's a structural necessity. Mass market policies have rigid caps because they're built for the average home. Their personal property limit might be $300,000. Well, what if you have fine art? A wine collection? That is just completely inadequate. H&W carriers understand that.
And what about the actual structure of the house? We hear about extended and guaranteed replacement cost. What's the real difference?
This is absolutely vital. Extended replacement cost, or ERC, is good. It gives you a buffer, maybe 25% or 50%, over your policy limit to account for inflation. But the gold standard, especially after what we saw with the Marshall Fire, is guaranteed replacement cost, GRC.
What makes GRC the gold standard?
It's the ultimate promise. The insurer agrees to pay the full cost to rebuild your home, like kind and quality, regardless of the policy limit. This is critical because of something called demand surge.
Explain that.
After a widespread disaster, every single person needs the same handful of contractors and the same building materials at the exact same time. So what happens? Labor and material costs can spike 20–30% literally overnight. GRC protects you from that spike.
If it's so important, why doesn't everyone offer it?
Because it's a huge risk for the insurer. Only specialized carriers like a Chubb or a PRE who operate on a different financial model are willing to make that full commitment. They're built for this kind of complexity.
And it's not just the policy language, right? It's the service, too.
Absolutely.
Yeah.
The service model is completely different. After a loss, you're not calling a 1-800 number and getting put in a queue. You get a single, dedicated claims adjuster who actually understands the value of what you lost.
And they're proactive, too. They try to prevent claims.
That's a huge part of the value. They'll often do complimentary home appraisals to make sure your RCV is right from day one. They'll do vulnerability assessments. They might suggest installing an automatic water shutoff valve, to prevent a huge water claim. It's true risk management.
And for our audience, many of whom are entrepreneurs or public figures, the liability side of this is it's non-negotiable.
It's the ultimate shield for your net worth. If you have complex assets or high visibility, your liability exposure from a lawsuit is massive. H&W policies integrate with umbrella liability limits up to $100 million or more. standard carriers.
Yeah.
They just can't touch that.
Okay, so let's bring this all together as we wrap up. The bottom line is, if you haven't had your policy professionally reviewed in the last 2 years, you are almost certainly vulnerable to a huge exposure gap.
It's that combination of percentage deductibles, outdated reconstruction cost estimates, and those mandatory code upgrades. I always say, I'd rather explain the cost of the right coverage to you now than try to explain why you aren't covered after a fire.
And we do something different than just sending a confusing PDF quote, which is what most agents do. We offer the custom video policy review. What is that?
The value is just total transparency. We send you a 5-minute custom video. A real person walks you through your current policy line by line and then compares it right next to our quotes. We show you on the screen exactly where the gaps are, the percentage deductible, the ordinance or law limit. It's personal, it's clear, and it's completely free.
Look, you can try to decipher these 50-page contracts yourself, or you can let us do it.
So how do they get the video review?
It's simple. Click the link in the description, upload your current declarations page. We'll shop 40 carriers, find the gaps, and send you a video breakdown of exactly what you should do.
And it's free.
100%. Click the link, get the quote. Sleep better knowing your wealth is truly protected. And as a final thought, build on that idea of guaranteed replacement cost. Some of these specialized policies offer what's called a cash settlement option after a total loss. So imagine this. You lose your home in a high-risk wildfire zone. Instead of being forced to rebuild right there, you have the flexibility to take the agreed value settlement and move your family somewhere safer. That level of freedom, that financial control in the worst moment of your life, that's only possible when you have a broker who can secure that gold standard of coverage. Think about that peace of mind. Thanks for tuning in to The Deep Dive.